Welcome to the EIS Navigator, the podcast for UK venture capital. I'm your host, Brian Moretta. Today, we are continuing with our EIS and VC Basics series, and we're going to talk about Seed Enterprise Investment Scheme Tax Release, or SEIS tax release. As a reminder, as well as the audio version of the podcast, you can see on video on YouTube. As we're going to talk about tax release, we need to add a little disclaimer that this is general for guidance and any details you may want to speak to your financial advisor. So delighted today, we are joined by Olivia Drinnan, who is a director or advisor fundraising at Haatch. Welcome to podcast, Olivia.
Thanks, Brian. It's really nice to be here on the other end of this. I'm usually the one listening, so really happy to be here today.
It's great that we've got a keen listener on. We had some of your colleagues way back on episode 85 talking in detail, but in case anyone didn't listen to that, do you want to tell us briefly who Haatch are?
Yeah, of course. So Haatch are one of the UK's leading EIS and SEIS fund managers. We invest in early stage companies with real potential for scale. So businesses that we believe that can achieve kind of global success. We've become well known recently for a string of profitable exits. We've actually had 4 successful exits just this year in 2025. One great example that's probably quite relevant today is an SEIS exit called Native Teams. And they sold just 2 weeks after the 3-year minimum period for a 7.4x return. So actually, when you factor in the 50% income tax relief, and we'll come on to talk about a little bit later, it was actually an effective return of around 12.8x for those investors. So super fantastic outcome and a real showcase of what's possible with SEIS, I think. Mm-hmm. Really uniquely, we're backed by a government-owned bank, the British Business Bank. So they invest alongside us in every deal we make for complete institutional validation. So if you invested in our SEIS today, BBB money would be invested alongside that. Super helpful for us because it actually means that we can go over the maximum we can invest in a company, which is 250k, and therefore it makes us more competitive in this space. And I'll just finish as to say that our funds are evergreen. We're known for our fast deployment times. So please do reach out if you're considering these products.
Excellent. So, but coming on to you sort of alluded to a couple of things. So
yes,
I think
jumped ahead.
I think in these schemes, while people like what they're investing in the underlying thing, the tax release are a really important part of what people are investing for. There's several of them, and they're maybe not quite as simple as we might like. So we're going to work through these, and you're going to tell us a little bit about what they are and how they work. So let's start with the income tax relief, which you've already alluded to. So what is the income tax relief in SEIS?
Yeah, so basically, this is probably the most commonly known out of the 5. So SEIS is the most generous tax efficient product in the market. It's had a massive popularity recently. The last statistics from HMRC say that they've increased by 50%. And I think this is because of the tax release that we're going to talk about today. But starting with income tax relief, you can claim 50% income tax relief on the amount you invest. Mm-hmm. So it's upfront tax relief that you receive when the money is live in the company, or what we call deployment. So it's important to ask about deployment timescales in that scenario. So as a simple example, you invest 10 grand, claim 5 grand back, income tax relief. So your effective cost is around 5 grand. But whilst it can feel like you're only investing 5 grand in this example, that full £10,000 is invested into those companies, which means you own shares on that full 10,000, and that's the total amount that participates in any future growth or returns.
Yeah, excellent. And there's some limits on that. Do you maybe want to tell us what those limits are?
Yeah, so the max that you can invest, unfortunately, is £200,000 per tax year. So therefore, per tax year, the max income tax would be £100,000. And you have to hold it for that 3-year minimum period that I've already cheekily referred to earlier.
Yeah, I think it's fair to say that for SEIS investments, 3 years is almost academic, in that most investments, maybe not all, but the vast majority will not exit or not successfully exit within 3 years.
Yeah, exactly. They're all early, so they need that time for sure.
Yeah. And I think the other thing that sometimes people could get concerned about or worried about is carryback.
Yeah.
So do you want to tell us about how carryback works in relation to income tax relief?
Yeah, of course. So the scheme kind of allows you to treat part of all of your SEIS investment as if it was made in the previous tax year, provided you stay within the 200k annual limit. So it actually means that you can invest £400,000 in one go, because it would treat it as 200 in this year, 200 in the previous year. So you could actually claim 200 grand back in income tax relief across 2 years.
Yeah.
So an incredibly powerful tool, great for investors looking to wipe out 2 years worth of income tax that they would have otherwise paid. And it's relatively simple to do. You just fill it out on your tax return, which providers like Haatch can help you with, of course.
Yeah. And it's probably fair to say that this is conditional on you having that income tax that you paid in the first place.
We do get that. We do get a lot of clients say, well, I've only paid 10,000, but can I claim 50,000 back? We're like, oh no, it's not free money. But it is a really attractive retrospective tax planning that you don't really find elsewhere other than these products.
Yeah. So as you say, that's the one that most people think about and get up front. Perhaps less common one, but also very important for those who can take advantage of it, is the capital gains relief. So do you want to tell us how that works?
Yeah, sure. I think actually I'll start because it is less commonly known. We're just telling the difference between EIS. So with EIS, if you have a capital gains bill, you don't kind of get rid of your capital gains bill. You just delay it. I like to say you're kicking the can down the road. You're deferring the gain. And the idea is that you're hoping to make returns and that will reduce it later down the line. But with SEIS, you can actually wipe out part of a CGT bill completely. So outright relief, no delay, no kicking the can, but there is less time flexibility with SEIS investors. So you need to act quickly. And you can only claim CGT reinvestment relief, it's called, on a bill crystallized in the current or previous tax year, as long as you use the carryback facility. But just to tell you a bit how this actually works, really simply, if you sell an asset and you reinvest that gain into SEIS shares, you can exempt up to 50% of that gain from CGT. So let's say you sold something for shares or property or whatever for £10,000. Your CGT rate is 24%. That would normally mean a £2,400 CGT bill. But if you reinvested £10,000 into SEIS, you can claim 50%. So £5,000 of that is completely exempt from CGT. So instead of paying that full 10,000 gains, you're only doing it on the 5,000. And at 24%, that's £1,200 in CGT relief, straight away, just relief. And there's a reason it's capped at that 50, because the other 50 you're already getting for your income tax relief. So you can't sort of double up on the taxes here. But I think for CGT reinvestment relief, you can see why SEIS is getting so much attention right now, especially with capital gains tax rates on the rise. It's just a really smart way for you to cut down that bill whilst also backing businesses with growth potential. You're sort of putting your money to work rather than paying it in tax.
Yeah, absolutely. And I think, I'll just throw in now, it's worth saying that some of these limits changed a couple of years ago. And I think that has made SEIS more attractive. So SEIS was founded, I think, about 2012, and the limits had stayed constant for like 10 years. And obviously inflation allowed for that. So you're now allowed to invest more. So companies can get more money under SEIS, and you as an investor can invest more, which I think has helped its popularity.
Definitely. And there's whispers as well. We're speaking to the Treasury at Haatch at the moment about maybe even making these more generous. So that's a special and exclusive.
That would be excellent news. So we shall watch.
No promises.
Yeah.
I hope you have risk warnings in this, Brian.
Yeah, we do. Possibly not this budget, I suspect. So that's capital gains on entry. What about capital gains on exit?
Yeah, so this is actually what I find a bit of a point of confusion, because there's two kind of reliefs that directly relate to capital gains, and some confuse reinvestment relief with the disposal relief, which is ultimately any gains you make on an SEIS investment are completely tax-free as long as you hold them for the minimum 3-year period. So just important to know, different reliefs, and it ultimately means that SEIS gives you a double CGT advantage. Half your reinvested gains are tax-free going in, and the rest is tax-free coming out.
Excellent. So yeah, we like tax free. So the next thing I want to talk about is the relief that probably most people find the most complicated, I think.
Yeah.
Here you're going to explain it very well, which is loss relief. It's the one we don't want to think about as well.
Yeah, hopefully I'll try and explain it as best as I can. I think that a lot of people overlook loss relief. I think it's one of those reliefs that both advisors, fund managers might shy away from discussing because understandably nobody likes to talk about failure. But the truth is with SEIS investing, some companies will fail. That's the nature of backing startups. But the key is to take a portfolio view. Don't get emotionally attached to any single business. I am such a hypocrite for saying that because I do that myself. But the reality is if a few companies go under, but the winners perform well, even at relatively modest returns of 2-3x, the overall portfolio can deliver incredibly strong results. And that's ultimately what fund managers like Haatch are here to do. Yeah. But if a company does fail, and I heard somebody on a previous podcast of yours call it a tax efficient cushion, which I thought was a beautiful way of explaining it. You have loss relief built in kind of tax efficient cushion, almost like a bit of a safety net. Mm-hmm. And this is particularly appealing for investors who are used to putting 100% of capital at risk elsewhere because you're not actually risking the full amount. So in really simple terms, in the same scenario I've been using throughout, if you invest £10,000, but let's say it's into a single company, just for this example, you're claiming that 5k back in income tax relief, but the company fails, you can offset £5,000 of that loss against either your income tax or capital gains bill. Most people do income because income tax rates are typically higher. Mm-hmm. So let's say in that example, if you're a 45% income tax rate payer, £2,250 you'd be able to claim back through loss relief.
Yeah.
So it's a really powerful, in even a total failure scenario. And obviously I've just used an example there of it being a single company. That's not realistic because we'll diversify your investment across multiple companies. But even if all of them failed, you could recover 70% of your original capital just with the income tax and loss relief. But then when you factor in the capital gains reinvestment relief, that can climb up to 80% of your investment. So this is sort of, I'm trying to paint the picture now of how they all work together really nicely, and it protects the majority of your capital.
Viewers may remember a couple of years ago, I did a paper on asset allocation, and one of the things what loss relief work, and I reckon loss relief added maybe 2 or 3% to your annual return. It's not fantastic, but it's not nothing either.
Yeah, and a lot of people are used to putting it all at risk. And so anything is good. So yeah, it is. I think we should talk about it and be proud of this kind of relief a lot more.
So next thing I want to just touch on is dividends. And dividends in some sense are really simple, but...
Yeah. Yeah, so dividends from SES companies are just taxed normally. They kind of don't offer additional dividend relief, but most early stage companies reinvest the profits rather than paying dividends, especially in the first few years. Mm-hmm. SEIS, where the true growth is in exits rather than dividends, I'd say.
Yeah, and we do have an episode further down the line, probably about a month after this one's released, on exits. So if you want more details, we've got someone chatting about those. The final thing I want to mention is IHT relief. Maybe explain how that works, because it's not quite straightforward.
Yeah, it kind of is and isn't. It's actually one of the most popular things that I've been talking about a lot with clients, with advisors recently. So SEIS shares qualify for up to 100% business relief from inheritance tax once they've been held for 2 years and at death. So ultimately, after 2 years, your SEIS investment can be passed on free of inheritance tax, if I can say it. Mm-hmm. This is a super hot topic at the moment, particularly with the planned inclusion of pensions within the taxable estate. So traditionally, a lot of people who have viewed their pension as something that they're kind of storing as a pot just to pass down to their kids outside of IHT. But with these potential changes, they're suddenly facing 40% inheritance charge. Mm-hmm. So what we're seeing now is a huge shift in the interest towards SEIS and EIS as well for those investors wanting that tax efficient way to pass their wealth on. So if you think you can actually use SEIS income tax relief to offset tax on pension withdrawals. So you're taking money out of your pension, using it to invest in SEIS, claiming tax relief on the way out. And then after 2 years, that same investment is 100% tax free.
Mm-hmm.
And you're not just parking them.
Tax free, we should say.
Yes. Yeah. And you're not just parking the money, you've kind of got potential for higher returns as well, definitely higher than you would see in a pension portfolio. So it's not it's not replacement for pensions, obviously, but it's definitely a complementary tool. And it kind of, it's definitely forming more core parts of long-term IHT strategy, I would say.
Yeah. It's probably also worth adding that the business relief rules were subject to announced changes in the 2024 budget. At the time of recording, these have not been enacted yet, but this will mean that business relief will only apply up to the first million of unquoted assets.
Correct. Yeah, it's from April 2026. It's an interesting one to cover because it's 100% up to the first million of total business relief assets in your estate. But after the 1 million point, you can still receive 50% relief. And we're hearing actually that that's still really lucrative and something that a few clients that kind of fall into that category are attracted to, because ultimately it's still far stronger than what pensions will offer potentially.
I think discussions of that I think there's some people sitting on the hand a little bit waiting to see what exactly how legislation pans out. But it's definitely an area where, coming back to the disclaimer, you should probably take advice if you're looking at this.
Definitely. And hopefully after the budget, me and you can do another podcast, Brian, and do full updates on everything that's been confirmed.
Thank you very much for coming on today. If anyone wants to find out more about what you're doing at Haatch, where should they go?
Yeah, so come to me if that's okay. My email address is olivia@haatch.com. It's Haatch with 2 A's. We've actually just created a no fuss guide to SEIS investing that covers everything I've spoken about, lots of case studies. It's client and investor friendly, and it was built in line with tax advisors Shoesmiths. So I'd love to share that on if you'd like to pop me an email. But thank you so much for your time, Brian.
No, my pleasure.
Good fun talking about tax.
Well, you've made it as interesting as I can imagine. So thank you very much.
That's very kind.
We'll post links to all those in the show notes. So as usual, you can get full show notes with links at harmonandco.com/podcast. You can subscribe to the podcast on all good podcast services and players or through the link in the show notes. If you like what you hear or see now, I just got to say, then please tell a friend or a colleague or give us a review on your favorite podcast app. You can also like us on YouTube. We can be contacted at inquiries@harmonandco.com. Thanks for listening, and we'll be back with another episode on knowledge-intensive funds next week.